Now speaking, Jessica Moore, Vice President, Investor Relations. Good morning. This is Jessica Moore, Vice President of Investor Relations for Johnson & Johnson. Today, we are reviewing our 2023 second quarter business results and full-year financial outlook. Joaquin Dueto, Chairman of the Board and Chief Executive Officer, Joe Wolk, Executive Vice President, Chief Financial Officer, and Eric Haas, Worldwide Vice President of Litigation, are joining me on today's call. We will review the second quarter sales and P&L results for the corporation and highlights related to the three segments. Joe will provide additional business and financial commentary before sharing an overview of our cash position, capital allocation priorities, and updated guidance for 2023. Finally, Eric will provide comments regarding the Talc litigation. In the second quarter of 2023, Johnson & Johnson reported strong financial results with total sales of $20.2 billion, a 5.3% increase from the prior year. The company also reported net earnings of $4.7 billion, a 7.5% increase from the prior year. The company's three segments, pharmaceuticals, medical devices, and consumer health, all reported positive growth in the quarter. Pharmaceuticals reported sales of $10.9 billion, a 6.6% increase from the prior year. Medical devices reported sales of $7.2 billion, a 4.1% increase from the prior year. Consumer health reported sales of $2.1 billion, a 1.8% increase from the prior year. Joe Wolk will provide additional business and financial commentary before sharing an overview of our cash position, capital allocation priorities, and updated guidance for 2023. Additionally, Eric Haas will provide comments regarding the Talc litigation. We look forward to your questions. Now speaking, Joaquin Dueto, Chief Executive Officer. Good morning, everyone. Johnson & Johnson had a strong quarter with market-leading performance, important advances in their innovative pharmaceutical and medtech pipelines, and a successful initial public offering of Kenvue. They reported operational sales growth of 7.5% and adjusted operational EPS growth of 9.7%. They also announced an exchange offer to split off Kenvue shares. In Medtech, they achieved 14.7% operational and 9.9% adjusted operational growth, excluding the impact of the Abiomed acquisition. This was driven by the publication of clinical data supporting the safety and effectiveness of QDOT, their newest ablation catheter for atrial fibrillation, and the completion of enrollment in the third clinical study evaluating their pulse field ablation solutions. In orthopedics, they received CE and CA Mark international approvals for their Velas robotic-assisted solution. In surgery, they are progressing on Ottava, their next-generation soft-tissue surgical robotic system. In pharmaceuticals, they delivered 6.2% operational growth, excluding the COVID-19 vaccine, driven by their multiple myeloma portfolio which grew more than 30%. They also achieved important regulatory and operational milestones, including multiple readouts from their pipeline, such as fast-track designation from the US FDA for all three prospective indications for Milvexian, a supplemental BLA for Carvykti, and positive top-line results from the Phase 3 Papillon study evaluating Rybrevant in combination with chemotherapy in patients with newly diagnosed lung cancer. They also presented initial TAR-200 data from the Sunrise-1 study in bladder cancer and positive Phase 2 study data for JNJ 2113, their novel oral IL-23 receptor antagonist peptide in psoriasis. They have also reached settlements regarding their Stelara IP with both Amgen and Alvotech. These strong results and upcoming catalysts give Johnson & Johnson great confidence in their near and long-term future performance. Now speaking, Jessica Moore, Vice President, Investor Relations. Kenvue Incorporated closed its initial public offering on May 8, 2023 and Johnson & Johnson continues to own 89.6% of total outstanding shares of Kenvue's common stock. In the second quarter of 2023, worldwide sales were $25.5 billion, an increase of 6.3% versus the second quarter of 2022. Net earnings were $5.1 billion, and diluted earnings per share was $1.96 versus diluted earnings per share of $1.80 a year ago. Excluding after-tax intangible asset amortization expense and special items for both periods, adjusted net earnings for the quarter were $7.4 billion, and adjusted diluted earnings per share was $2.80, representing increases of 6.5% and 8.1%, respectively, compared to the second quarter of 2022. Pharmaceutical segment sales increased 3.1%, with growth of 9.2% in the U.S. and a decline of 4% outside the U.S. Medtech segment sales increased 12.9%. With growth of 14.6% in the U.S. and 11.3% outside of the U.S. Consumer health segment sales increased 5.4%, with growth of 6% in the U.S. and 5% outside the U.S. Cost of products sold leveraged by 80 basis points, primarily driven by favorable patient mix and lower COVID-19 vaccine supply network-related costs in the pharmaceutical business, partially offset by commodity inflation in the consumer and medtech businesses. Selling, marketing, and administrative margins deleveraged 20 basis points, driven by incremental costs to support the standalone consumer health business, partially offset by proactive management of costs. The effective tax rate was 23.9% versus 17.6% in the same period last year. This increase was primarily driven by 2023 tax costs incurred as part of the planned separation of the consumer health business due to the internal reorganization of certain international subsidiaries. Excluding special items, the effective tax rate was 16.6% versus 15.4% in the same period last year. Adjusted income before tax for the enterprise as a percentage of sales increased from 34% to 34.6%, primarily driven by favorable product and patient mix, partially offset by unfavorable segment mix and commodity inflation. Pharmaceutical margins improved from 42% to 42.7%, primarily driven by favorable patient mix, sales, marketing, and administrative expense leverage, and R&D portfolio prioritization, partially offset by higher milestone payments. Medtech margins improved from 26.5% to 28.6%, driven by favorable intellectual property-related litigation settlements and cost management initiatives, partially offset by commodity inflation. Consumer health margins declined from 25.9% to 23.5% due to incremental costs to support the standalone consumer health business, foreign exchange impacts, and commodity inflation, partially offset by supply chain efficiencies. Kenvue Incorporated closed its initial public offering on May 8, 2023, and Johnson & Johnson continues to own 89.6% of total outstanding shares of Kenvue's common stock. In the second quarter of 2023, worldwide sales were $25.5 billion, an increase of 6.3% versus the second quarter of 2022. Net earnings were $5.1 billion, and diluted earnings per share was $1.96 versus diluted earnings per share of $1.80 a year ago. Excluding after-tax intangible asset amortization expense and special items for both periods, adjusted net earnings for the quarter were $7.4 billion, and adjusted diluted earnings per share was $2.80. Representing increases of 6.5% and 8.1%, respectively, compared to the second quarter of 2022. Pharmaceutical segment sales increased 9.2% in the U.S. and declined 4% outside the U.S. Medtech segment sales increased 14.6% in the U.S. and 11.3% outside of the U.S. Consumer health segment sales increased 6% in the U.S. and 5% outside the U.S. Cost of products sold leveraged by 80 basis points, primarily driven by favorable patient mix and lower COVID-19 vaccine supply network-related costs in the pharmaceutical business, partially offset by commodity inflation in the consumer and Medtech businesses. Selling, marketing, and administrative margins deleveraged 20 basis points, driven by incremental costs to support the standalone consumer health business, partially offset by proactive management of costs. The effective tax rate was 23.9% versus 17.6% in the same period last year. Adjusted income before tax for the enterprise as a percentage of sales increased from 34% to 34.6%, primarily driven by favorable product and patient mix, partially offset by unfavorable segment mix and commodity inflation. Pharmaceutical margins improved from 42% to 42.7%, primarily driven by favorable patient mix, sales, marketing, and administrative expense leverage, and R&D portfolio prioritization, partially offset by higher milestone payments. Medtech margins improved from 26.5% to 28.6%, driven by favorable intellectual property-related litigation settlements and cost management initiatives, partially offset by commodity inflation. Consumer health margins declined from 25.9% to 23.5% due to incremental costs to support the standalone consumer health business, foreign exchange impacts, and commodity inflation, partially offset by supply chain efficiencies. Kenvue Incorporated closed its initial public offering on May 8, 2023, and Johnson & Johnson remains the majority shareholder. In the second quarter of 2023, worldwide sales were $25.5 billion, an increase of 6.3% versus the second quarter of 2022. Net earnings were $5.1 billion, and diluted earnings per share was $1.96 versus diluted earnings per share of $1.80 a year ago. Excluding after-tax intangible asset amortization expense and special items for both periods, adjusted net earnings for the quarter were $7.4 billion, and adjusted diluted earnings per share was $2.80, representing increases of 6.5% and 8.1%, respectively, compared. Now speaking, Joe Wolk, Executive Vice President, Chief Financial Officer. Thank you for joining us today. We reported strong results across all segments for the second quarter and the first half of 2023. Adjusted operational sales growth by pharmaceuticals, excluding COVID-19 revenue, accelerated 6.2% over the first quarter of 2023, and Medtech operational sales increased 4.5%. We executed against our long-term business strategy and achieved key clinical and regulatory milestones. We also made considerable progress toward the separation of Kenvue, with an update on our next step toward the separation being an exchange offer as our next step in the separation. We ended the second quarter with approximately $29 billion of cash and marketable securities and approximately $46 billion of debt for a net debt position of $17 billion inclusive of approximately $7 billion of Kenvue net debt. Free cash flow through the second quarter was approximately $5.4 billion. We are raising full-year operational sales and EPS guidance despite some strategic items not accretive to EPS. We now expect operational sales growth for the full year 2023 to be in the range of 7% to 8%, or up $1.4 billion, in the range of $99.3 billion to $100.3 billion on a constant currency basis, and adjusted operational sales growth in the range of 6% to 7%. We anticipate a slight improvement to our adjusted pre-tax operating margin driven by expense management. We have reduced our other income estimate to be in the range of $1.6 billion to $1.8 billion. We now anticipate a reduction of net interest expense to the range of $150 million to $250 million due to interest income on the net proceeds linked to the Kenvue separation. We are maintaining our effective tax rate estimate in the range of 15.5% to 16.5%. These changes result in us increasing our adjusted operational earnings per share guidance by 10 cents per share to a range of $10.60 to $10.70, or $10.65 at the midpoint on a constant currency basis, constant currency growth of 5% at the midpoint. Our reported adjusted earnings per share for the year increases by 10 cents per share to a range of $10.70 to $10.80, or $10.75 at the midpoint, reflecting growth of 6% at the midpoint. We continue to anticipate stable procedure volumes and healthcare staffing levels in the back half of the year with normal seasonality. We expect continued strong growth in the back half of the year in pharmaceuticals, slightly higher than the first half. We remain very confident in our ability to meet our 2025 pharmaceutical sales target of $57 billion. We have many important catalysts for the remainder of the year that can drive meaningful near and long-term value, including better commercial execution and recently launched innovative products in Medtech, expected approval of Talc in relapsed or refractory multiple myeloma, Phase 3 data for Tremfya for Crohn's disease and ulcerative colitis, the results of the Mariposa study of Rybrevant plus Lasertinib in frontline non-small cell lung cancer, Phase 1 data for TAR-210 in non-muscle invasive bladder cancer, and Phase 2 data for Nipocalimab in rheumatoid arthritis. Now speaking, Eric Haas, Worldwide Vice President of Litigation. Thank you, Joe. On Tuesday, July 18, a jury in Alameda County, California ruled in favor of the plaintiff in the case of Valdez v. Johnson & Johnson on his talc product liability claims. We intend to appeal this decision based on the erroneous rulings by the trial judge that prevented us from sharing with the jury critical facts that demonstrate the plaintiff's exceedingly rare form of mesothelioma was not caused by baby powder. Decades of independent scientific evaluations have confirmed Johnson's baby powder is safe, does not contain asbestos, and does not cause cancer. The verdict award will not be paid while the bankruptcy proceeding continues, and this decision has no impact on that process. A motion to dismiss hearing took place in the last week of June and the bankruptcy judge is expected to rule by August 2. A hearing on the motion for LTL's proposed reorganization plan and voting procedures process in the path forward is scheduled for August 22. Johnson & Johnson stands by its position that its talcum powder products are safe as confirmed through decades of numerous independent scientific tests and studies. Wells Fargo Securities analyst Larry Beagleson inquired, Eric, if Judge Kaplan dismisses the bankruptcy proposal, what alternative settlement do you have in mind to contain costs? Joe and Joaquin, do you expect the medtech market to grow 5 to 7% this year, despite JNJ's range? Eric Haas replied, Larry, hi, it's Eric. Thanks for the question. If Judge Kaplan dismisses the bankruptcy, we intend to fight the claims aggressively. We have decades of scientific support for the safety of our talc products, and they do not contain asbestos or cause cancer. We are confident in our ability to prevail in the vast majority of claims. Joaquin Dueto replied, thank you, Larry. We are pleased with our first quarter results in Medtech, which saw growth of 8% year over year. Our sustained improvement in performance over the last couple of years has been driven by a combination of factors, including the recovery of overall market procedures, improved commercial execution, and a steady flow of new product launches. We anticipate similar growth in the second half of the year. Joe Wolk replied, yes, Larry, Joaquin's comments are spot on. We anticipate that China volume-based pricing and international sanctions in Russia will limit our growth in the back half of the year. However, we have already accounted for these factors in our outlook, so we feel confident that we can manage them. If either of these issues abate, it could be beneficial for our future. Guggenheim Partners analyst Vamil Devan inquired, what are your expectations for biosimilar entry before Amgen and how does that impact your guidance expectations for this year? What has changed since April to give you a sense that the data from Mariposa may come earlier and be presented this year? Joe Wolk replied, thanks for the question, Vamil. With respect to Stelara, there won't be a significant impact this year. Most of the business was contracted for the full year last year, so there's no material impact. We don't expect any changes before January 1, 2025. Eric, do you have anything to add from a legal perspective? Eric Haas replied, thanks, Joe. We believe that Amgen and other tech are the best positioned biosimilars in the market. We do not anticipate any other biosimilars entering the market before them. Joaquin Dueto replied, thank you for your question. With respect to Mariposa, the event-driven study is still on track with the final analysis expected by the end of 2023. We remain optimistic about the potential of Rybrevant in combination with lazertinib to become a new standard of care in first-line non-small cell lung cancer with EGFR mutations. We look forward to presenting these results at a major medical meeting this year. Citi analyst Joanne Wunsch inquired, given the strong performance in Medtech this year, do you anticipate a new base from which to grow, or will we be facing difficult comps next year? Additionally, with Kenvue split off, what investments are being considered for the Medtech and pharmaceutical franchises? Joaquin Dueto replied, we are pleased with the 8% growth of our Medtech business in the first half of the year, driven by market growth and improved commercial execution. We have introduced several new products, such as Octare mapping catheter, QDOT treatment catheter, AccuView Oasis Max, Technis ENS, Vela's robotic-assisted system, medial stabilized cementless knees, hip navigation, Cuptomize, InSeal jaw curved, and Echelon 3000 stapler. We have also completed enrollment of our dual energy catheter and have started with the first patient treated in removal of kidney stones with our Monarch system. We look forward to more updates on our Ottava soft tissue robotic system before the end of the year. Overall, our Medtech business is delivering competitive growth and good news in innovation. Joe Wolk replied, Joanne, with respect to the consumer health separation, our capital allocation priorities remain unchanged. We will continue to invest in our own pipeline and maintain our percent to sales for R&D. We prioritize this as it is essential for our future success. We have already returned a significant amount of dividends and share repurchases to shareholders this year. We are always on the lookout for strategic opportunities that fit with our clinical or scientific expertise or commercial capabilities, which can drive more value from an asset than it currently has. J.P. Morgan Chase & Company analyst Chris Schott inquired, what is your level of confidence in achieving the $57 billion pharma target by 2025? What is the update on the number of plaintiffs with regards to the Talc settlement terms? Joaquin Dueto replied, thank you, Chris. We remain confident that we will reach our $57 billion target by 2025. Our pharmaceutical portfolio is progressing well with excellent results in Darzalex, Tremfya, Erleada, pulmonary hypertension, and long-acting injectable antipsychotic franchises. Our new product launches, Carvycci, Tekayeli, and Spravato, are also performing well. Carvycci is showing a clear improvement quarter-over-quarter, and Tekayeli is having a faster introduction than Darzalex. Spravato is now a $1 billion-plus product. Our pipeline is also progressing, with Talcatamab, GPRC5D-CD3 bispecific antibody, Milvexian, Factor XI oral anticoagulant, TAR-200, Rybrevant, lazertinib, and Nipocalimab all making progress. We are also developing an oral IL-23 receptor antagonist peptide for psoriasis and ulcerative colitis. This renewal of our portfolio puts us in a strong position beyond 2025. Eric Haas replied, at the June 30th hearing, we found that there are approximately 60,000 claimants in support of the plan and 40,000 in opposition. The evidence presented during the hearing indicates that the majority of claimants are in favor of the proposed plan, and we anticipate additional support will be forthcoming. Credit Suisse analyst Trung Nguyen inquired, can you provide an update on the Talc outcome and any potential similar suits in the near future? Also, can you clarify if another interim has passed from Mariposa? Joaquin Dueto replied, we are on track to complete our analysis of the Mariposa project by the end of the year. We anticipate presenting the data at that time. Eric Haas replied, with respect to the Talc suits, we do not anticipate any additional individual actions outside of the bankruptcy. Judge Kaplan lifted the stay only for the Valdez case and denied a request from the same counsel to lift the stay on another case. Therefore, we do not expect any other cases to move forward before a ruling on the motion to dismiss. Morgan Stanley analyst Terrence Flynn inquired, Joaquin, what strategies do you have in place to capture a majority share of the $20 billion myeloma market? Joe, what can you tell us about margins post-Kenvue's full separation? Joaquin Dueto replied, thank you for the question. Our goal in myeloma is to have 3 out of every 4 patients starting a Janssen-containing regimen by the end of this decade. We are planning our development with Darzalex as a backbone of therapy, and sequencing into Carvycci, Talcatamab, and Tekayeli. Our aim is to treat to cure, rather than treat to progression, and increase treatment duration. This gives us optimism about the business potential of this area, and we foresee a great patient and growth opportunity. Joe Wolk replied, Terrence, thanks for your question about margins and the potential deleverage that could occur with the Kenvue separation. We previously estimated $500 million to $750 million of SG&A costs that could be eliminated. We've been working hard to reduce those costs on a faster timeline, and we expect very little, if any, deleverage in from the Kenvue separation. UBS analyst Danielle Andelphi inquired, Joe, how has the integration of Abiomed changed your appetite for larger deals in medical devices and medtech? Are there any specific areas of cardiology or medical devices that you feel you are undersized in and could benefit from expanding? Joe Wolk replied, Yes, Danielle, our appetite is strong. We are looking for deals that are a strategic fit and provide financial value, regardless of size. Joaquin, can you provide more insight into the areas of interest? Joaquin Dueto replied, Thank you, Danielle. Abiomed integration is progressing well with 20% growth on the quarter. We're continuing to move forward with enrollment in key PMA studies and are increasingly convinced this will be a key component of our medtech strategy. When it comes to M&A, we look for opportunities that improve patient care and are agnostic to medtech and pharmaceuticals. We're looking for opportunities to grow into areas close to our existing expertise, such as vision, cardiovascular, surgery, and high-growth orthopedics. Our history in tuck-ins, licensing, and collaborations has been successful, with external innovation representing 50% of our pipeline. We're open to larger transactions in both medtech and pharma, but all transactions must clear certain financial milestones. Licensing, acquisition, and collaborations remain key factors in our growth moving forward. Cantor Fitzgerald analyst Louise Chen inquired, What are your latest thoughts on IRA and its potential impact to the drug industry and JNJ? How do you expect CARVYKTI to expand into earlier lines of treatment and more widely into the community? Joaquin Dueto replied, We remain concerned about the government price-setting environment of the IRA, which creates a disincentive to innovation without addressing patient access. It's still early to calculate the business impact, but we believe our diversified portfolio puts us in a good position to grow beyond the second half of this decade. We are working to improve CARVYKTI supply by increasing capacity and reaching agreements with other companies. We have filed for CARVYKTI 4 and are working on CARTITUDE 5 and CARTITUDE 6 to move it into earlier lines of therapy. We are increasingly confident that CARVYKTI will be one of our more than $5 billion assets. Jessica Moore replied, Thank you, Louise, for your question. I apologize to those we couldn't get to due to time constraints. I encourage you to reach out to the investor relations team with any remaining questions. Now, I will turn the call back over to Joaquin for closing remarks. Joaquin Dueto replied, Thank you, Jess, and thank you all for joining us. I'm proud to report that we have had a strong first half of 2023. We are well positioned to capitalize on our two-sector focus in pharmaceuticals, medtech, R&D, and innovation. We look forward to keeping you updated on our progress. Thank you and have a great day.